we have our offering memorandum, but as analysts and real estate professionals, we know that the offering memorandum and the statistics or the information in this only goes so far. So we need to take it a step further and do our own analysis and figure out some other key assumptions and metrics to see if the deal truly works by not just looking at the memorandum.
All right, well, show us if it works or not.
All right. So we'll jump over into a pretty straightforward underwriting model. And so, like I said, the first thing we're going to go through some of the core assumptions that you'd be looking at when you're doing financial analysis of a real estate deal. To start off, we're going to look at our asking price, and the big difference between our asking price, which a lot of times is that pretty number that brokers might put on the offering memorandum. But we know we're savvy negotiators and we're savvy financial analysts, so we know that we're going to hopefully drop that number. So we need to take a look at what our acquisition price is going to be, and for the sake of just the model to see how it works, well, let's say that we come in and we offer them $9.5 million. Now, commonly, a lot of times, an analyst will use the actual acquisition price for a lot of return metrics, but we're equity investors and we want to know how much the total deal price is, or the total purchase price, including anything that includes closing, right? These might be items such as, closing costs in relation to buying the property, getting reports, getting environmental studies, and other things in due diligence.
Title fees, you're going to have attorney's fees, you're going to have all kinds of things. If you are leveraging it, which would be putting, financing on it, you might have some points or, application fees and things like that too. Wouldn't you, Jordan?
Exactly, Michael. I mean, there's a long list of different things that, you're going to be needing based on what, your organization or you personally find most important during the due diligence process, or things that you would need to close.
Excellent.
So for the purpose of us going through this analysis, we're going to call this the all-in basis, or the all-in purchase price, meaning all the money that's required to get this deal done. Another thing we're going to look at, I should say, is the square footage, right? This is super important because in order for us to look at different metrics or compare different properties, we have to look at things on a per square foot basis. For example, the price per square foot. So if I'm an analyst and I'm a smart analyst, I go into a market and I say, well, I'm going to get this deal for 620 or so, dollars per square foot. Other types of Walgreens or CVS's or other pharmacies, are they fetching the same price, or is there room to maneuver to get to that market value, right? This can be favorable or unfavorable, but it's another way to look apples to apples at some of the market competitors.
Yeah, and another thing that you and I talk about all the time, Jordan, is that if that purchase price is $621 per square foot, what's the construction cost in the market? So we know that since we went through this, this is in a very dense urban area, and there's not a whole lot of vacant land to build on. But still, if we were building this in the Chicago area today, it'd probably be around $250 per square foot. So if there was vacant land across the street and there was just a big cornfield and it was really easy to develop, you'd want to make sure that you weren't paying this much per square foot, because another developer could come along and bring Walgreens across the street, and actually give them the same type of thing for less money.
Exactly. And another great benchmark when you're looking at the price per square foot is take into consideration the replacement costs, or the amount of money per square foot it would take to rebuild the property and its value. So a good benchmark is to say, well, this deal is coming in below replacement costs. Sounds like that's a good purchase price. Right.
And just on your model here, I just want to point out that where it says square feet GLA is gross leasable area.
Yeah. So a lot of times You might have a couple acres of land, but you're going to want to analyze the deal on a per square foot basis based on the gross leasable area, meaning all of the leasable area that you're actually going to be getting income on, right? In this scenario, you're not going to be getting any parking income or anything like that. So you're going to isolate here to the GLA.
So, and then the land price is probably a reasonable amount on the land price, because that's just about what land is going for over there.
Right. So for the purposes of this analysis, we're going to assume that we buy this property because we're going to go through our due diligence period. We're going to make sure we're checking the boxes off and get the deal closed efficiently. So we'll assume that we're buying this property, January 1st, theoretically, on 2021. Now, a couple things to look at here, and these are super important for a few different reasons. We want to look at the age of the property. Has it been, and when has it been renovated? And what type of lease term does the tenant have? Because a lot of these things are going to come in to how we're going to evaluate the property's value and also assess the risk of this specific property. And so what that does is it feeds into our capitalization rate, or commonly known as a cap rate. And simply put, the cap rate itself is just measuring the property's return or yield in a 1-year time frame, so that I can go out and say, well, you know what, this property has a capitalization rate of 6.5. The market is really going around to 7.5, and I can see apples to apples again if that's a competitive cap rate. Now, I will speak a little bit more to cap rate, and we'll get into this further when we jump into the annual cash flows. But the capitalization rate, the formula is as such. We take our first year's, or our forward year, net operating income, okay? And that's revenue minus our operating expenses. And we divide it into our purchase price, right? So it's the percentage of our first or forward year income as a proportion to our all-in purchase price. Now, for purposes of leasing and taking a look at risk, some of the things that are going to change a cap rate, because again, it's something that we use to see how much return we should expect. If I have a shorter term lease, right, I would expect that my cap rate goes up because it's a little bit riskier and I want to make a higher return on that. Now, you would think, well, wait a minute, the return's going up, what happens to the purchase price? Well, it's inversely proportional, because the higher my risk or the higher my cap rate, the lower I'm going to want to pay for a property to ensure that I have a cushion to meet those effective returns.
So the cap rate is basically like if you were putting your money in the bank, what the interest, and you invested the full $9,600,000. You put that in the bank. That's the interest rate that you would be getting. And so if you paid less, you would actually be getting a higher interest rate.
Yeah, so it's the yield or the return that you would want to expect to get based on the income of the property to its purchase price.
Could you give an example of some properties where some traditionally have higher cap rates and some traditionally have lower cap rates?
Sure. So I'll give you an example. A restaurant tenant. Now, we know that in this day and age, it can be very volatile business because restaurants can go in and out, right? You might have a new tenant every 5 years. So
does In-N-Out have a good cap rate?
I think they own most of their own properties, but they would have a really high cap rate if they were on the market.
Yeah, so let's distinguish quickly between that. So there's something like a McDonald's, right? It's corporately owned. And then there's a family small business restaurant, okay? And a small business family restaurant isn't as well capitalized. So the tenant itself is a little bit riskier. So in that case, well, if I'm taking on this risk, well, I need to get a higher cap rate or yield in order to meet my risk tolerance. And as the cap rate goes up or the risk increases, my purchase price that I'm willing to pay for it goes down.
Yeah,
In a different instance,
and even extending the McDonald's analogy, if you get McDonald's Corporation on the line, you get billions of dollars backing that lease. So that lease is guaranteed by those billions of dollars of market cap. But you could also get a very successful McDonald's franchisee, but you're not going to pay the same cap for that because McDonald's is not guaranteeing the lease. It's the franchisee guaranteeing the lease. So they could be actually better operators than McDonald's corporate, but you don't get the same financial strength back in the lease.
Exactly. And so one of the big things with your cap rate is the credit worthiness of the tenant itself. Is it a guaranteed lease by a personal guarantee or guarantor? Is it backed by a massive corporation, or is it a family-owned business? Either way, it'll adjust appropriately with that.
And I could even tell you a different cap rate story. So you can have a McDonald's that's in the middle of Dallas, Texas, and that could be, even a 4 cap. Or you could have a McDonald's that's, let's say, in Lubbock, Texas, or someplace out in the Permian Basin where there's not as much population. Even if they have the exact same lease terms, there's a little bit more risk because you're fairly certain that you're going to release the space faster in McDonald's or in Dallas if McDonald's leaves than you would in the middle of Texas where there's much less population.
Exactly. So it's important to look at the market too, not just the tenant itself. Because if it's a higher performing market, you can expect that, again, like Michael alluded to, that you can get a new tenant fairly quickly because the market performance is much higher than the alternative.
So it's a less risky investment.
Exactly. Now, another thing, and what we're going to jump into next here, is the debt that we put on the property. So we know that we have our equity, but we want to put some leverage on our property so that we can basically increase the amount of investments and the ability to invest in multiple deals with the same amount of money.
Yeah, and I'm just going to interrupt you. This is like the best thing, one of the best things about real estate, in addition to the excellent tax benefits and other things. But you can't invest, or you could, but it's much harder to invest in the stock market or other items. You can control, let's say, a $10 million property here and only have to put, less than half of that in. So you get more assets. And then the other thing is, the great thing is that this tenant, this corporate tenant that has all this billions of dollars of backing behind them, is paying your loan down. So they're actually putting money into a sinking fund, and you're building principal every year.
Yeah, exactly. I mean, it's a huge benefit, right? And another benefit about this is there's some ways that you can look at debt, and you can use that as a vehicle to help your returns, which we'll talk about a little bit later. But that's an also key benefit.
And I just want to say one more thing about debt. It is fairly easy to get debt on one of these properties if it's backed by like a Walgreens or a McDonald's or one of the major corporations that we work with, because the bank knows that the tenant is guaranteeing the lease. And so the bank isn't depending on you necessarily to pay back the lease, or isn't necessarily assuming that if you're buying a 12-unit apartment building that all those tenants are going to pay their rent. They know that these tenants are going to pay, and so that they'll give you a much better deal on a triple net lease like this, backed by a conservative, well-financed corporation. And banks love doing this all day long because they know that there's a high probability that they're going to get paid back.
Exactly. And and that also, it all comes back again to that cap rate. That also helps that move south or downward, because I mean, the more credit worthiness you have in that tenant to be able to pay the debt through the rent, the lower the risk is and the lower the cap rate. Now, to speak to the interest rate of your mortgage, let's say, right now we're in a pretty favorable interest rate environment, and the Federal Reserve has given us guidance that it should stay there fairly low for the foreseeable future. Now, the lower
I'm just going to interrupt you there. So that means do not keep your money in the bank, because you will be losing money keeping your money in the bank. Invest it in real estate.
Absolutely. I mean, this is a perfect environment to buy properties at a low interest rate. I mean, you can get such a lower monthly pay, or I should really say monthly to annual payment on your debt service that can really do wonders for your return.
It goes with your phrase, Michael, bonds wrapped in real estate.
With net lease properties, absolutely.
Yeah, exactly. Yeah, so I mean, since the lower the interest rate environment, the lower the cap rate, because I mean, it goes back to your income, right? The more secured your income, including debt, the lower risk you're going to be able to take on, essentially.
All right, fantastic.
So we'll jump a little bit more into some of the ways to look at our debt service and how to measure the performance of your property based on that. But let's keep going through the assumptions. Now, we want to make sure, because we know this is one of the most important things, is how much is the annual rent on the property. And typically with the single tenant net lease deals, you're really only going to have of course, one tenant to take a look at. So it is also important to take a look at the lease and to see how many options are there. Because if I've got a tenant who has a 10-year lease, that's great. But if they don't have any options after those 10 years and you go to sell the property, you might be in trouble with the sales price, right? Because it's going to be riskier for the seller, or the buyer, I should say, down the road. Another thing in larger deals that have multiple amounts of tenants or a large load of tenants is what we call a vacancy factor. And for the purposes of our single tenant net lease deals, because they are like bonds wrapped in real estate, and there's a lot of good, credit worthiness, and they continue to renew their leases, we don't typically have a vacancy factor here, right? Because there's not more than one tenant to take into consideration.
And I just want to mention one statistic that we've seen over the years, from the year 2009 all the way through to the end of 2019, and it pretty much has not changed that dramatically. But single tenant triple net leases have averaged between 97.5% occupancy all the way on up to like 98.5% occupancy. So in terms of, fully occupied properties or close to fully occupied properties, triple net leases have the best track record in terms of vacancy factor.
Absolutely. And, it's interesting too, and to bring up that point, Michael, about net lease properties, is that they're extremely efficient from an occupancy standpoint, especially in a down market.
Yeah, because the great thing about this is that these tenants' leases, even if we're in the middle of a COVID situation right now, which we are, or if you're in the middle of the downturn, I've been through 4 downturns, the tenant leases are long-term leases. So unless there's an issue where they cannot pay, they continue to pay through ups and downs. So it's a very conservative investment.
Absolutely. And that's a lot of times why we see these lower cap rates on those properties, because our risk is a bit lower. It's a great point, Michael. Thank you. So if we keep moving on, we have to take into consideration a few other things, right? We looked at all the pretty stuff, the income, but now we need to make sure that we're capturing the expenses. Now, because this is a triple net type of property, there's only a few types of expenses that we're going to be responsible for. These might be some administrative fees that, based on our internal costs. These might be a operational reserve that you might want to hang on to just in case you might have to pay for something that you're responsible for. But typically, for expenses in a triple net deal, the tenant is going to be responsible for everything, including property taxes, the advertising cost or promo, insurance, as well as paying a management fee. Does that make sense?
Yeah, absolutely. And what we do, because we're super conservative in our underwriting, a lot of people wouldn't do this, but so we just have this in because in certain situations, there might be a triple net deal, which is like this. And there also might be a net deal where we would have to be responsible for the repairs. We would want to get rewarded with a higher cap rate if we looked at something like that. But we make sure that we underwrite everything that goes into it. So where you see additional expenses, we know that at the end of the year, we're going to have to, at least have our accountants or somebody, even if we're doing it ourselves, we have to allocate time to, preparing taxes and things like that. And we also, just to be conservative, throw in a management fee because even if you're not, you could hire a manager to do it, and 3% is probably on the high side for something like this. But even if you're managing it yourself, you're going to have to do the bookkeeping. You're going to have to call the tenant to make sure that they send you the insurance and add you as an additional insured. And you absolutely want to at least check the tax rolls and make sure that the tenant paid the property taxes. Even if they're a large national corporation and these guys have that stuff set up automatically, there's sometimes where, there's mistakes get made. Somebody, fat fingers, a data entry point, and all of a sudden you see that the taxes weren't paid. So we just try and be very conservative when we underwrite, just so that we know that we're getting a true return. Whether you're doing it yourself or somebody else is doing it, there's the most valuable thing you have is your time.
Absolutely, Michael. And you know what? I'll add to that about property taxes, and I'll give you a little secret of the trade when it comes to more conservative and pretty, I should say, generally more accurate to projection analysis. Is when you're looking at property taxes, and if you for some reason have to pay that, whether in a single tenant deal or elsewhere, it is important to take your all-in purchase price and apply the county or the local municipality's tax rate to your new value. Because as soon as it's public information that this deal is going to happen, so you can expect that there's going to be either a drop or a jump in your property taxes. Now, if you do have to pay property taxes, that's okay, because the reason that the local or I should say federal government gives you the ability to write off your property taxes is because they want to give you incentive to invest in that specific market or submarket, right? So at the end of the year, when you get all of your this is how much you made, now you're going to pay the taxes, they're allowing you to write that off, right, using what's called depreciation. And depreciation, it sounds like just that. It's when I buy a property, right, every day I'm paying to use that property, right? So I should see the benefit of losing, general value based on how old my property is getting. And I should be able to realize that loss on my taxes. So it gives us a more tax efficient vehicle to invest your money in.
Yeah, so let's back up there. So you had the property tax thing, and then you went into the federal government. It allows you to deduct expenses. A lot of people might get concerned because if your property taxes on your personal house get over $10,000, then it's not deductible. But since this is commercial property, those property taxes are fully 100% deductible as a business expense if you are paying them. And then exactly what Jordan said, the federal government creates these tax laws and writes these tax laws to induce people to make investment into communities, to make investment, because they know that real estate investment, they know that manufacturing investment and all the rest of that stuff creates jobs, it creates flourishing communities, and it creates services so that people in this community can go and get their prescriptions and stuff. So the federal government says, we want to encourage building, we want to encourage taking care of real estate, we want to encourage this type of investment because we know that this grows our economy. So they write the tax laws to give incentives for people to make this investment. So that's how we get to depreciation, because otherwise, if you didn't have depreciation, as Jordan said, we wouldn't be, budgeting or making plans to invest in this property in future years.
Yeah, exactly. It just sounds like commercial real estate investment benefits more than just the buyer and seller.
Commercial real estate investment, contrary to what some people are saying about landlords, this creates all kinds of spillover effects. So number one, the reason why tenants, larger tenants, and everybody wants to do this is they don't have to spend their own capital to build this property. Somebody else comes in and invests their capital to build this property, to own this property, to control this property. And so they know that they can control this property for 20 years. They know what they're going to have to pay over those 20 years. So it's basically like a financing thing for those tenants. So it's great for the tenants, but the tenants, by operating there, not only create construction jobs, like I said, everything else, there's spillover effects. So having this brand new, nice, shiny building there, it creates spillover effects for the entire community, which again, goes down to the state. People are paying income taxes. People are paying property taxes. That provides things, for police officer salary, fire department salaries, and everything else. And it goes all the way on up to paying taxes on the total level, for the U.S. government to provide whatever they do sometimes.
I just want to zone in a little bit more on the spillover effects too. Are there any projects that we have as an example, Michael, maybe where we've seen it in action?
Oh, well, we redeveloped a number of properties, and because the properties were on the decline and because there was a lot of vacancy and all the rest of it, and once we went in and redeveloped, one of them was a very large mall, which we ended up emptying out and tearing down and then putting a Walmart there and some other tenants in there. And once we did that, it triggered all kinds of development around there, because retailers, I like to say, are like lemmings. And so if they see some action happening, they say, oh, this is a good corner. Let's all try and get on this corner, which is why we're interested in looking at this particular property here, because there's all kinds of like exciting action going on around it. So we know it's in the retail nexus. So Jordan, why don't we keep going to annual cash flow?
Don't mind if I do. This is the best part, right? Now we've spent our time, we've done our research, we've put the appropriate assumptions in, and we've gotten the right data that we need. We now can take a look at and analyze the annual cash flows and the respective return metrics. So we mentioned before that to get to net operating income, we take our revenues from our tenant and we take out our operating expenses, including things like your any additional expenses, your parking, roof, and structure, or any other expenses that you might not be receiving from a recoveries standpoint from the tenant themselves. So now that we know our net income, we can take a look at our first metric. And that's one of our key metrics that we like to use is the free and clear return. What is our return on an annualized basis, free and clear of any debt or capital expenditures? And in this case, this is coming in, we see that every year it's 5.7 and so on and so forth. And we get our average 10-year free and clear return of 5.8% in this specific deal. Now, we know that this might not work out because we remember that our yield that we were looking for based on the capitalization approach was somewhere at 6.5. So we have to further do some research to see if the leverage is going to help us out meet our required returns or our risk threshold. So now we take into consideration our debt service. And this is going to be either a first or second mortgage, depending on how many mortgages you're putting on the property. Traditionally, one would take for this size of the property just one loan, but the larger the size of the investment, the more debt you might have to place on it. So you might have here your senior loan, and then you can also place a mezzanine note or what's called subordinate debt, right? Because that is they only get the second cash flow. So they don't get the money first. And if something were to happen, the senior loan in this case, or the first mortgage, would have access to that money first. And then the subordinate note in that case would get access to the money second.
So Jordan, when you say debt service, that if we went out and got a loan or a mortgage, debt service would be both the principal and the interest payment?
That's correct. In some cases. Now, there are cases where you can, and like we said, debt can be flexible sometimes. That's why it's a benefit. A lot of times people will do an interest only period, maybe as an incentive for the bank to place the loan. But that's something that you might see. And typically you would see that on this type of deal over a 1-year period.
So,
but yes,
on your model here, what you're saying is debt service is the total payment that you're making to the lender.
That's correct. And in this case, it's our interest and our principal. So it's the total amount of money we're paying to our loan servicer.
And then as you were talking about first mortgage, second mortgage, sometimes known as mezzanine debt, basically what you're saying is that in the unlikely event of a foreclosure, if they foreclosed on the property and let's say they lent us like $6 million and they foreclosed on it and could only sell the property for $5 million, that would mean that the second mortgage wouldn't get any money. That's the way that works?
Yes, in some cases, yes, but that's the base
That's
theory.
why I say it's a riskier position to be in because they're not in the first position. And then
and in that position or in the mezzanine position or any type of subordinate finance vehicle, you can expect that because the risk is higher, the interest rate that they're going to command is going to be higher as well.
And we should also point out that the first position on every type of loan is the property taxes. So the government gets theirs first. And then the second position is the first mortgage. And then if you've got another second mortgage or a mezzanine lender, they get theirs. And if there's nothing left, then the equity holders don't get anything, correct?
That's correct. So that's why we have to put our risk thresholds in place, right? That's why it's one of the reasons that financial analysis is so important, because if the deal, it might look pretty on the outside. It might be exciting on the outside, but if the economics don't work out, it's just not a feasible deal to do.
And you don't want to get in that position of getting a foreclosure, even if you've got a stellar tenant.
Absolutely.
Okay, let's go.
All right. So now that we've paid our debt service, we have our cash flow before taxes or cash flow after debt service, or also what's called our levered cash flow. Now, we talked about leverage earlier. It's just being able to take your equity and lever it up just like a lever you would see on a crane to apply torque so you don't have to use as much pressure. And essentially we get more use of our equity proceeds.
So the lever is you can move the big rock.
Exactly. And you can do that, and we'll talk a little bit about how you can potentially move that lever to adjust your returns based on what type of debt you're taking on and some other items.
Because after all, the podcast name is Nothing But Net, and we're on the call with an ex-basketball coach.
We are. I'm here. I'm here. I'm learning.
So what I'll say about the metrics involved after we've placed our debt service or in relation to the debt service are three. And they're very important for a couple of different reasons. And I'll start with our debt metrics. When I go to a bank and I say, look, do you guys want to we want you guys to give us a loan for this deal. We're not the only ones underwriting this. Those guys on the other side or the other party are going to underwrite it as well. And they're going to say, well, wait a minute. If I'm willing to give you this loan, I have to meet certain thresholds or certain returns as the creditor to be able for this to be a safe investment for me to give you this loan. Because the reason I'm giving it to you is get that consistent debt service. And one of the big things, and you're going to hear this a ton of times in commercial real estate investing, is the debt service coverage ratio. Here in our model, we see it's the DSCR. Now, a bank is going to give you a loan and they're going to say something like this. If you drop below what's called your debt service coverage ratio, then you might be in default of your loan. So, as an underwriter, we want to make sure that we're taking a look at what is our debt service coverage ratio and are we meeting that threshold on an annual basis. In this case, we take our net operating income and we divide it into the annual debt service, right? So it's the amount of net operating income that you're making over your annual debt service. So in this case, we have a 1.7x. And typically you might see a traditional debt service coverage ratio for a loan like this, somewhere in the ballpark of 1.2, 1.25. So we can see here that our minimum debt service coverage ratio meets that threshold or exceeds that threshold. So it could be a good investment for the bank and we won't default on the property based on our projections. Now, another good way to take a look at and what you also might see in the note is what's called a debt yield. And this is your net operating income as a proportion of the initial balance of the loan. And so why we do that, or why a bank looks at that, is to see what kind of growth they're getting year over year in net operating income, so they can see that there's some sort of cushion to pay this debt as well. And so it's also a key metric for us to look at to see how the property is performing year over year.
And I just wanted to mention some of the older mortgage guys will also do debt per square foot too, because they want to, as we talked about, you want the purchase price to be at or close to replacement cost, if possible. And so the debt guys also want the debt below replacement cost in a lot of situations. That they'll take every situation independently, but they'll also, want to make sure about that to make sure that there's a cushion, if the property was vacant or something like that, when they had to foreclose and sell it at a distressed price, that they had cushion to sell it at.
Exactly, right. So they're investors themselves, so they have these different metrics to make sure that in the unlikely event that the property is default, are we going to be able to sell this appropriately and get our money back?
Okay.
So as we keep going, now we kind of get to the more meat and potatoes, if you will, of the value of the property. And the way to value the property in this case is to use our cap rate, if we remember, right? So in this scenario, we have a growth rate. And it's very important to apply a growth rate or not apply a growth rate based on your projections or looking at the market and future interest rate yields to see what's going to happen with the cap rates in your given market. In this case, because we're conservative, we don't think that we're going to get a decrease in the cap rate because the property is getting a little bit older. So we're not going to say that we're going to get a better cap rate because, again, as we know from the beginning, that the lower your capitalization rate, the higher your property value is going to be, right? So you're taking a big risk by saying, oh, well, you know what? This cap rate's going to drop 50 basis points or 0.5%, and I'm going to get that much more on my sales price in 10 years or so. So once we have our net operating income for 11 years, and we do 11 years because we need to take the forward year net operating income and apply a cap rate to it in order to get our reversion value or our sale price. Okay. And so in that case, we want to take a look at our unlevered IRR. Now, let me just stop for a second and tell you a little bit about what internal rate of return, or commonly known as IRR, is. The IRR really is the discount rate that makes the net present value, or NPV, of all cash flows equal to 0. But let's set aside some buzzwords there. What it really means is it's your expected annual rate of growth in the investment of your future cash flows, or your 10 years worth of cash flows.
All right, so let's break this down. Internal rate of return basically takes how much you actually put into the deal in equity, and then each and every year that you get a return gets added into that. Plus, when you go to sell the property, it kind of adds up all those things and gives it to you over time. And so that's what your internal rate of return is, correct?
That's correct, because this is a metric, as we know, we looked at before. Some of our other returns would just give us an annualized number, right? But here we want to take a look at the whole life of the investment and the growth in our returns and how it's performing over the total entirety of the deal.
So what you're saying is the cap rate is kind of a snapshot in time, and the internal rate of return is I'm looking out into the future.
Yes, theoretically.
All right,
And
Adam, you said something. I'm sorry.
Yeah, and how do you stack up? How do you compare the IRR to a metric like cash on cash?
Sure. Well, Adam, I'm so glad you brought that up, because one of the things that we'll talk about now is our cash on cash. At first, we did talk about our free and clear return, but the second thing we want to look at, because it's an important metric to see, is what is my annual return on the equity invested, and that's cash on cash. And so in this case, we've invested, I believe, somewhere in the neighborhood of $6 million. So we need to take a look at, after we've paid our debt service, our operating expenses, what is our return on an annual basis as a percentage of our initial investment, right? So basically our return on investment, right, on an annual basis. And in this deal, if we look towards the top, it's a 5.5 cash on cash. So just to clear that up first, and then Adam, I'm sorry, could you repeat your question for me?
Yeah, just, what are the main differences between the two? I see that the percent is close or similar if you compare year 10 to the average cash on cash, but I think that's a compelling aspect, as well as what is the investor going to see in return on a yearly basis compared to the IRR, which is kind of like more of a projection of what it will be by, for example, year 10. We're seeing 4.81 there.
Exactly. And two big differences is the cash on cash is an annual return, and it also doesn't take into consideration your sales price. So it just isolates your annual income, right? Because you want to take a look at how that's performing over the life of the investment, whereas your internal rate of return, or IRR, is going to consider everything involved, right? Your purchase price, your annual income, and your reversion value, or your sales price.
Mm-hmm. Yeah, and why don't you change the reversion value? Because let's say I told you I don't think that the reversion value that is going to be a 6 cap. I think it's going to be closer to the cap rate that we bought it at, which I think would be around a 5.5. So what would that do to our internal rate of return?
Sure. So in theory, as we talked about earlier, when my cap rate decreases, my value goes up. So if I'm looking at an IRR over the life of my investment, it should boost the return. So if we take a look here, let's say we put in whatever it takes us to get to what did you say, Michael? You wanted a five and a half.
Like we bought it at a 5 cap, so let's go with a 5.5 cap exit. Yeah, we get better returns.
Yeah, we get better returns. Like, so
And
yeah,
the
so we
goal
get
is to sell it at
so,
the same cap rate because the rent is going to go up, or hopefully we're buying in a good enough area where the cap rate actually goes down.
exactly. So as we noted before, if internal rate of return takes into consideration all events or capital events during the life of the investment, the higher the purchase price at the end of the investment, the higher your IRR is going to be.
And I just want to point out for non-finance people that internal rate of returns are never going to be really that great on these type of investments because they're net lease investments. And so people are mainly buying these things for passive income, and they're buying them because they're super safe, and they're buying them that they know that they're going to get this cash flow every month, year in and year out. And so people don't expect to see a super huge decrease in cap rates. And they don't expect to see, I mean, even if you look at cap rates over the last 10 years, they've pretty much traded in a very narrow band. So that's what, you know, the takeaway here is I see a lot of investors get hung up on internal rate of return, and it's a good metric when you're doing a development deal and there's no money coming in initially, and then there's all kinds of money coming in later. With these things, it's sometimes much better just to keep it simple and say, how much money am I going to get over the life of the loan, or I'm sorry, over the life of the investment. So with that, where are we going to go to next to wrap this up, Jordan?
Well, we'll just talk about one more thing, and that's looking at our hold period and how to use the IRR over 10 years to see how long you should really be holding this property.
Okay.
So the last two things we'll talk about here, and just first, let me just note to what Michael said about multiple metrics. There is one that is one of my favorites, and it's called the equity multiple. And it's just taking all of your positive cash flows, including your sales price, if it is positive, hopefully it is, and you divide that into your purchase price to get a way to see your total return over that entire period based on an actual dollar value instead of a percentage.
And that's a key thing. I need you to hit on that one more time, because with net lease properties, we're really concerned about cash on cash and the equity multiple, because the internal rate of return doesn't really show it as much as those two things that we would want to like kind of track.
Exactly. You're going to capture more on with the following metrics: your cash on cash return and your equity multiple, rather than your IRRs in this type of deal, because there's not as many moving parts and it's more a stable investment. But the theory for what's called a matrix is just the same, because you're just using this this tool, I should say, to see what year should I hold this, or what should my hold period be to get the most optimal return. And in this case, it's year 10. You can see here that our investment up and through year 4 is we're not going to be getting an IRR return, right? And that's why we don't necessarily look at this in this type of deal. And you're not going to meet your IRR or your highest IRR or maximum IRR until year 10. Conversely, you're going to take a look at your cash on cash return. You're actually getting a return every year with this type of, bond wrapped in real estate, essentially, as you mentioned before. So it's more important in this type of deal to take a look at what am I making, what kind of cash am I getting in my hands every year, and what is my equity multiple, or how much money am I making over my initial cash investment.
And so the last thing is, let's go to taxable income, because this is where the key thing that separates real estate from bonds, because real estate, a lot of people are investing in municipal bonds because they don't have to pay, state income taxes on those municipal bonds, but they're getting this, paltry return. I mean, I tell people at the library board that I'm on the library board, we just sold a municipal bond, and I think that the numbers went out at a 1.5%. So you can do this type of real estate investing, and you're getting this cash flow, but that cash flow, as we talked about with the depreciation, is sheltered. So you're getting actual cash flow, and then you're only paying taxes on a portion of that cash flow. So can you just show us that real quick, Jordan?
Yeah, absolutely. So if you take a look here, what you're going to see is how to essentially get what your actual taxable income is. And, the beauty about this is you're seeing what's my actual in-pocket cash return, and you can look at different metrics that way. Now, one of the big things with this is you'll take your essential gross income that you've got, you'll take out your total expenses, right? So we get a write down. You'll get to your net operating income, as we spoke before, but here's the kicker. In this case, if I want to be taxed less, my income has to look less. So one of the benefits is you're allowed to write down your debt service, or the interest on your debt service, I should say. And you're also able to write down your depreciation, right? So take those two things into consideration, and there's some calculations that go into that. But in essence, you take those things out of your net income, and instead of being taxed on $550,000, well, wait a minute, I'm only being taxed on $115,000 of that, because in real estate investing, I can get the benefit of depreciating my asset from an accounting standpoint. I mean, that's just beautiful.
Yeah, and so the key thing there is, if you're looking at the spreadsheet, is you are with an accounting maneuver reducing your actual taxable income by close to $200,000. And we're not even doing anything which we, a lot of sophisticated investors would do, which is doing a cost segregation study and moving some of those pieces forward and getting even more depreciation. This is just your plain vanilla depreciation. So you are actually pocketing $200,000 worth of that and only paying taxes on what's left over. And then the great thing, as we talked about with the debt service, is you're leveraging that to buy bigger properties, and you're paying down your principal with that debt service. The principal is not covered by it is not deductible, but that interest is. So this is why we really love real estate investment. And Jordan, we love the fact that you kind of broke it all down for us, and it's why we really love net lease investments, because they're fairly simple to analyze. I know the spreadsheet looks big, but at the end of the day, they're fairly simple to analyze. They're fairly simple to manage, and you get, I don't want to say guaranteed income, but when the tenant signs a corporate lease, they are guaranteeing that lease. So you're getting some super strong backing behind that lease.
Absolutely. And one of the things with the more tenants you get, or the more assumptions that you have to take into consideration, the modeling itself will grow exponentially. But, when you're doing financial analysis for these types of deals and other deals as well, is don't get hung up too much on, certain return metrics and certain income line items. You really just want to break it down from your cash perspective, if you will. Taking a look at your annual returns based on what kind of risk profile or returns that your investment strategy is accreted with.
Fantastic. So, Adam, do you have any more questions?
No questions, but just a statement to kind of back up what you're saying there, Michael. I think, first of all, really grateful to have Jordan come on and go through the model with us here today. It helps clarify a lot of things. And what you were saying, Michael, I think this is a really interesting sector of commercial real estate that most people just don't know about, because there's not a lot of education out there on it. So happy to kind of be at the forefront of this and hopefully open a lot of people's eyes in regards to some alternative investments that can really help not only create but preserve wealth. I know that's, one of our missions, and your mission to begin with here, Michael, is, education, helping people not only in the US but around the world preserve and protect their wealth. So it's just been a really helpful episode.
Yeah, and I just want to say, if anybody wants to get in touch with Jordan, and talk a little bit, you can contact him at hello@libertyfund.io. And you can just put in the subject line Jordan, or if you want to contact me or Adam, you could do the same thing and just put in who you'd like to contact. But
you can
really
also put
together. Sorry.
So you could also put cigars and smooth jazz in the subject line. We'll know that it's for Jordan too.
You hit it right on the money there, Adam. Anytime you want to do smooth jazz, cigars, and talk financial analysis for commercial real estate, I'm your guy.
He's a big whiskey drinker too, so we're good on all of those.
All right, love it. Cool. Well, yeah, Jordan, it sounds like we got your closing remarks here. Michael, I guess I'll open it one more time. Any closing remarks for either of you two? We'll start with Jordan.
No, I just want to thank Adam and Michael. Thanks for putting this podcast together. It's got a lot of great investment advice and material that you can use in your future or your commercial real estate investment journey. So thank you so much for having me.
Mm-hmm. Michael?
And as always, the reason why I have guys, very smart rocket scientist type guys like Jordan and some of the other people around is because I went to a public school and can't do math. So they make sure my numbers and my assumptions in the models that I build, I send them over, and then they just say, Michael, we'll just start from scratch and we'll take it from here. So, but I really do appreciate you coming on and breaking down some complex concepts into bite-sized pieces. And hopefully it doesn't intimidate people, because I just want to say, this is one of the easiest places that you can get into real estate. And if you can get some smaller net lease properties, you can build up a really nice portfolio. And it's kind of like, they say in the military, it's a fire and forget missile. So you make the investment, and then there's not a whole lot to do, because nothing but net means no taxes, no toilets, and no termites.
There you go. You know what, Michael, I just remembered, is there going to be like a skeleton version of the financial model for our listeners or anyone who is watching today?
Yeah, if somebody does want to, we've got a kind of a slimmed down version, because they don't need all of this stuff. We'd be more than happy. So if you want to get in contact with us, again, go to hello@libertyfund and just put financial model in the subject line, and we will get something out to you as soon as possible. And if you want to see more information and more articles and more, we've even got some special reports up there, especially on net lease investing and triple net investments. Go to libertyfund.io. We're constantly building stuff up. We've got a number of podcasts up there now, and guest podcasts too, which give some extra light on net lease investments and how great they are.
Perfect. Thank you very much. All right, guys. Well, you were tuned in today to another episode of the Nothing But Net podcast, the podcast for triple net commercial real estate investing. I'm your host, Adam Carswell, joined as always by my co-host, Michael Flight. We will catch you guys in the next episode. Thanks.